This year alone, I saved about $40,000 in taxes on one of my buildings using a strategy called cost segregation. Most real estate investors have heard of the term, but very few actually understand how it works. So in this video, I'm going to break it down using my own real numbers. Hey, what's up guys? My name is Mike Doherty. I'm a full-time real estate investor and realtor with eXp Realty. Over the past several years, I built a portfolio of over 100 rental units and closed more than $150 million in real estate sales. About 6 years ago, I left my corporate job to pursue real estate full-time, and now I help clients and investors buy property, scale their portfolios, and build long-term wealth through real estate. On this channel, I break down the practical strategies I've used so you can do the same whether you're buying your first rental property or growing your portfolio. And in today's video, I want to break down how I saved roughly $40,000 in taxes in 2025 calendar year on one of my office buildings that I'm actually recording this video in today. And that is called cost segregation. So, if you like practical investing strategies like this, no fluff, no guru talk, make sure to hit that like button, subscribe to the channel, and drop a comment below with where you're at in your investing career. All right, let's get into it. All right, let's talk about what cost segregation actually is. Normally, when you buy a commercial building, the IRS says you can depreciate over 39 years. If it's a residential rental property, it's 27 and a half years. So let's say you buy $1 million office building. After taking out the land value, $800,000 is assigned to the structure because, as we know, we cannot depreciate land. So if you take the $800,000 of depreciation and divide it over 39 years, that's about $20,500 per year that you can take every year in deductions. But that's slow and will take forever to finally depreciate the full building. So what a cost segregation does is it breaks the building into components instead of treating it like one giant 39-year asset. Cost segregation engineers analyze things like flooring, lighting, interior partitions, electrical systems, plumbing, cabinetry, millwork, parking lots, landscaping, site improvements, and many of these components legally qualify as 5 on a 15-year property instead of a 39-year property, which allows you to accelerate depreciation and front load your deductions. And again, this is not a loophole, it's just the tax code. Now let me give you a real life example of how I used cost segregation to save $40,000 on taxes this year. So I own a 10,000 square foot professional office building, what I'm recording in today in Farmington, Connecticut. I purchased this property about 3 years ago for about $1.5 million. And after allocating the land value, our depreciable basis was about $1.2 million. Now I own this 50-50 partnership, so whatever tax savings are generated, I'm only going to get half. Without cost segregation, almost all of that $1.2 million would sit in that 39-year property, over 39-year depreciation. With the study, here's how it actually broke down. Roughly $157,000 was classified as a 5-year personal property. $181,000 was classified as a 15-year site improvement, and the remaining $871,000 stayed in that 39-year property. Now, because bonus depreciation was still in effect at 80% when we placed it into service, we were actually able to front load a big portion of that shorter life property in 1 year, which actually created over $100,000 in additional depreciation compared to doing nothing. At my effective tax rate, and because I only own 50%, that translated to about $40,000 in tax savings to me personally. Thinking about relocating to West Hartford, Connecticut? Well, I've got just the thing for you. My team and I have actually taken the time to create the ultimate relocation guide, which is ultimately meant to save you hours of research, and I've linked it down below. From top employers to the best hospitals and a boatload of other things that you're going to need to know before making the move. The best part is this guide is 100% free. That's right, you heard me, 100% free. Just click the link in the description or the top pinned comment. Hope that helps. All right, now let's talk about how a cost segregation actually works. Now, this isn't your CPA guessing the percentages in an Excel. This is a professional third-party company specializing in cost segregation reporting that is compliant with the IRS. The firm I used was called Mavin Cost Segregation Tax Advisors. Now, I don't get any kickbacks. I'm happy to put you in touch. I just really think they did a good job. Now, essentially what they did was they reviewed my closing statements from when I bought the property. They reviewed land allocation. They analyzed the construction components of my office building here. They broke down the mechanical, the electrical, and the plumbing systems. They reconciled the total cost basis. They provided an audit-ready documentation that's ready for the IRS to review, should I get audited. And I've actually done 2 of these reports. So on the office building speaking about today, that saved me $40,000. I met someone at the property, physically met him here, and I gave him a tour. We looked at the basement. I took him through every room. He took a bunch of photos, and from there, he'll send those photos back to the consultant for them to finish the report. On a separate building I did a cost seg on, I actually did a Google Meet video, and I virtually walked the inspector around the property. Now, I'm not actually sure why one person was physically here and the other was virtual, but ultimately it led to the same tax saving. So at the end of the day, the most important thing is whatever company you choose to make sure they follow the IRS cost segregation audit technique guidelines. That's the most important. So if you're going to do this, you want to do it correctly. Now, a lot of people call this a loophole. It's not. Here's what makes it powerful. 1, accelerated depreciation is legal. Bonus depreciation allows you to deduct a large percentage of shorter life assets up front. You can apply it retroactively using a Section 481 adjustment. Your accountant will know what this is. And the last one's big. Think about it. If you bought a building 3 to 5 years ago and never did a cost segregation like I did on this office, I bought it a few years ago and never did anything, you can potentially catch up, which is what I did. And I can catch up on the missed depreciation in 1 year without amending prior returns. That's huge. That can create a massive paper loss in the current year, like what I just took on $40,000 loss. Now you might be asking, when does this make sense? Cost segregation does not make sense for everyone or for every property. I have a bunch of properties I haven't done it on. It typically works best when you're in a higher tax bracket or you have active or passive income to offset. It also works well if the property is usually worth around $500,000 or more. It's more powerful if it's a commercial or larger multifamily property and if you plan to hold on to the asset long term. However, you can still cost seg a single family rental or a short-term Airbnb rental. And what's even more important is if you qualify as a real estate professional under the IRS rules, this strategy can be even more powerful because you may be able to use those paper losses against active income. You also need to think about depreciation recapture when selling, but that's at a future event. Most long-term investors benefit from more upfront tax savings. So what does a cost seg actually cost? So for the office building I did that saved me $40,000, the cost segregation study cost around $4,500. Now it helped create over $100,000 in accelerated depreciation. So when you think about it from an ROI perspective, that's an unbelievable return. Typically, smaller properties might cost anywhere from $3,000 to $5,000. Larger commercial buildings can be anywhere from $5,000 to $10,000. But again, if the numbers make sense, it can be one of the highest return decisions you ever make as an investor. Here's the bigger lesson. Real estate isn't just about cap rates and cash flow. It's about depreciation, tax strategy, leverage, structuring ownership properly, and understanding the tax code to a degree. Let the professionals do the bulk of the work. But just being knowledgeable about the overall tax code can save you a lot of money, like knowing what cost segregation is and how to use it. Now imagine stacking that across multiple commercial buildings over a 10-year period. That is how you build wealth quietly and strategically. Now, if you got value from this breakdown, make sure to hit that like button, subscribe, and comment below what you want me to cover next. Thanks again for watching and subscribing.